Okay, we have all been there, right? It's that exact, totally infuriating moment every single e-commerce owner hits at some point. You pull up your Shopify dashboard and you're staring at a payout of, let's say, $4,000. Great. But then you open QuickBooks and the deposit sitting there shows something like $3,800. And to make matters worse, you check your actual bank statement and somehow you're looking at a completely third number. No way, right? You're sitting there staring at unmatched numbers across all your platforms, nothing ties together, and somewhere in that frustrating gap is hours of your life that you are literally never getting back. And let's be honest, you're usually doing this at 2 a.m. on a Sunday.
Look, if you have ever felt like you're just, bad at bookkeeping, or that you somehow set up QuickBooks wrong and ruined everything, take a deep breath. Seriously, as the experts point out, the core problem here is structural, not technical. It is not a you problem. I repeat, not a you problem. This is a fundamental flaw in how these specific platforms communicate with each other. And today we're gonna fix it.
So welcome to the Explainer. Today we are tackling what we call the $0 discrepancy. We're going to unpack exactly why your multi-channel and SaaS payouts always seem like a total mess. And, way more importantly, we are going to systematically map out the automated, bulletproof ways to fix your messy historical data and get your books flawlessly, perfectly balanced.
Here is our diagnostic roadmap for today. We'll quickly cover the reconciliation nightmare, why those payouts never match, the clearing account secret, sync tools versus subledgers, and finally, how to choose the exact right tool for your specific business.
Okay, Section 1, the reconciliation nightmare. Let's dive right into this universal pain point of manually tracking multi-channel sales because it is a headache we all share.
For a really long time, a lot of sellers just relied on Shopify's native QuickBooks connector. It was free, it seemed super easy, but if you were using it recently, you know exactly what happened in January 2026. A forced migration essentially broke syncing for thousands of stores overnight. It was chaos. Orders stopped pinporting, customer records just vanished into thin air, inventory tracking was completely wiped out, and massive cost of goods sold discrepancies suddenly appeared out of nowhere. Relying on a basic connector that basically works until it doesn't is absolutely no longer a viable strategy if you're trying to grow a business.
Which brings us to Section 2, why payouts never match. Let's peel back the curtain and look at the complex, hidden mechanics of what is actually happening before a payout ever even hits your bank account.
Think of a Shopify payout like a sealed envelope. When that envelope finally arrives at your bank, you know exactly what it weighs. That's the final deposit amount. But hidden inside that sealed envelope are dozens of invisible deductions. Before they even sent it, Shopify already took out their processing fees, the shipping labels you bought, third-party app charges, refunds from last week, those super annoying $15 chargeback fees, and even the multi-currency conversion spreads.
And that beautifully illustrates the math problem we're up against. You see, QuickBooks is sitting there expecting to see your gross sales, and then it wants separate expense entries for your fees. But Shopify just sends the final net bank deposit. Because Shopify netted all those fees and refunds silently before the money ever left their platform, the deposit will never, ever perfectly match your gross revenue on a one-to-one basis, not without specialized help anyway.
Now here's a really fascinating, completely hidden trap in this whole process, the gift card gotcha. Almost every default connector natively maps gift card sales as instant income. This is a massive myth, and honestly, it's a direct violation of GAAP accounting rules. When someone buys a $50 gift card from you, that is a liability. You literally owe them future goods. It only becomes revenue upon actual redemption. If your system maps this wrong on day one, your reconciliation breaks instantly. Boom, just like that.
So, moving on to Section 3, the clearing account secret. We've officially diagnosed the illness, so now let's pivot and talk about the magic weapon used by professional e-commerce accountants.
Enter the clearing account. This is essentially a fake intermediate bank account set up inside your QuickBooks. Think of it as your unpacking zone. Instead of dumping that sealed envelope directly into your real, actual checking account, the clearing account receives the gross sales, the refunds, and all those specific tiny fees. It gives every single deduction a proper place to land, perfectly balancing the math before the final net amount transfers over to your real bank. It's brilliant.
Because of this, there is a crucial golden rule you have to remember. This fixes the absolute most common user error you'll see on Reddit, accounting forums. Listen closely. When that final net payout shows up in your QuickBooks bank feed, you must never ever click Add. Clicking Add actually duplicates your income because the clearing account already recorded the sales. You must always click Match to tie that bank fee deposit to the transfer that originated from your clearing account.
All right, Section 4, Sync Tools versus Subledgers. Let's see how all these principles build up and help us evaluate the specific automation frameworks we have available in 2026 to handle this whole shebang automatically.
When you sit down to set up an automation tool, you basically face a fork in the road: summary sync or itemized sync. Itemized sync tries to push every single individual transaction into QuickBooks. And let me tell you, if you have high order volume, you will turn your accounting software into a cluttered, sluggish nightmare of a transaction database. For most growing businesses, summary sync is the absolute gold standard. It pushes one beautifully balanced journal entry per payout period, keeping your books incredibly clean while making reconciliation an absolute breeze.
And that brings us to the two major categories of tools on the market right now, which are beautifully represented by PayTraQer and Finlens. PayTraQer is an incredibly powerful sync tool. It aggressively pushes data from everywhere, Shopify, Amazon, PayPal, Square, directly into QuickBooks. But at the end of the day, it's essentially a sync engine. Finlens, on the other hand, is what's called a revenue subledger. It doesn't just push data, it securely holds all that complex, transaction-level evidence completely outside of QuickBooks and only passes the finalized, pristine accounting conclusion over to your ledger.
So, if you run a Stripe-heavy SaaS or subscription business, a subledger like Finlens is practically a non-negotiable must-have. Why? Well, it comes down to ASC 606 deferred revenue recognition. Think about it. If a customer pays you $12,000 upfront for an annual software subscription, you cannot legally just log that as instant cash on your P&L. It legally must be deferred across all 12 months. Standard sync tools really struggle with this, but a subledger handles it natively, right alongside tracking complex dispute lifecycles and automatically generating your crucial MRR and ARR metrics.
Finally, Section 5, choosing the right tool. We have covered a ton of ground today, so let's distill all of this into a tailored, actionable solution just for you and your business.
Here is your ultimate cheat sheet to take away from this explainer. If you are doing under 50 orders a month, keeping it small, you can totally get away with spreadsheets or a lightweight tool like 𝐒𝐻𝐿𝐴. If you're a high-volume physical product seller on multiple channels, like say Shopify plus Amazon plus eBay, you're going to want a powerhouse sync tool like PayTraQer or 𝐒𝐵𝐺ility. If you are a Stripe-based SaaS company, you absolutely for sure need Finlens. And if you are doing massive, true enterprise-level volume across countless channels, well, it's time to bite the bullet and invest in custom API automation.
Now, I know the idea of plugging some brand new tool into your pristine accounting software is a little terrifying, but remember that top-tier tools always offer a safety net. Applications like PayTraQer feature a comprehensive undo and rollback function. If you accidentally map your accounts wrong on your first try and accidentally push a giant mess into QuickBooks, you can just cleanly click Undo All to wipe the slate entirely clean. No harm done, and absolutely no permanent damage to your historical data.
As we wrap up, I want to leave you with this final, somewhat provocative thought. Take a hard look at your accounting tech stack right now. Are your current books just a messy, cluttered log of sync transactions? Or are they a structurally sound, truly reliable source of truth? The tools are out there to fix the structural problem. It is officially time to stop manually matching payouts at 2 in the morning and start letting the systems do the heavy lifting for you.